Welcome to Financial Insights in Minutes. Today, we dive into a real estate crisis shaking Texas and Florida. Are you ready?
We'll explore collapsing home values, tactics to buy rental properties without cash, and rising homebuyer regrets.
Stay till the end for a summary of expert opinions. Like and subscribe for top financial insights. First, Reventure Consulting's Nick Gurley explains why Texas and Florida's housing markets are collapsing. Next, Ken McElroy divulges strategies to buy rental properties with no money. Then, Melody Wright warns about skyrocketing mortgage delinquencies and homebuyer regrets. Jason Walter presents why the housing market has hit a wall despite lower mortgage rates. The BiggerPockets panel dissects Airbnb bans and sinking cities impacting real estate. Eric Nelson from Real Estate Mindset showcases Zillow's latest data on inventory and price cuts. Jason Walter also reveals eye-opening trends in the California housing market. Finally, Dave Meyer from BiggerPockets outlines repeatable steps for buying a rental property in 2024. Welcome to Reventure Consulting on YouTube. Today's hot topic: why are the housing markets in Texas and Florida falling apart? Our guest, Nick Gurley, is here to break it all down with data-driven insights.
Absolutely. Nick reveals some shocking numbers and trends. This episode is a must-watch for anyone interested in real estate, whether you're buying, selling, or just curious about market dynamics.
So what's the main takeaway from Nick Gurley's analysis? What's causing this market meltdown?
The core thesis is that a massive inventory spike into Texas and Florida is causing housing values to crash. Nick warns that this is just the beginning, pointing to inflated prices and crumbling affordability as critical factors.
All right, let's dive into those key points. What's the scoop with the inventory surge?
Texas and Florida together boast an eye-popping 250,000 homes on the market, the highest in 7 years. Compare that to just 90,000 homes in the entire Northeast, and you get a sense of how unique this problem is.
And how did these markets get here?
Pandemic booms saw tons of people and investments flood into Texas and Florida, sending prices soaring. Now, builders, investors, and remote workers withdrawing from the market are exacerbating the downturn.
Wow, that's a classic boom and bust scenario. How about the city specifics?
Tampa has doubled its inventory in just 1 year, now at 16,000 homes. Orlando isn't far behind with an 82% increase. These places are experiencing unprecedented price cuts as a direct result.
So, what's the affordability situation like?
In Florida, households are using 45% of their income on housing costs. That's double the pre-pandemic rate. Texas isn't much better at 36%. People simply can't afford these prices.
All right, let's whip out the crystal ball. What predictions does Nick have for us?
First, expect continued price declines in these markets as long as affordability issues stick around. Second, even if the Fed cuts interest rates, dropping mortgages to around 6.5%, it won't significantly boost housing demand.
Summing it all up, what's the big picture here?
Nick emphasizes staying realistic. Buyers and sellers should carefully monitor local inventory and price trends. It's going to be a tough market in Texas and Florida for a while. Stick to data-driven decision-making.
Welcome to the Ken McElroy Show on YouTube. Could you ever imagine buying a rental property with no money down? Of course you can.
Absolutely. Ken McElroy shows us how, with strategies like subject to and seller financing, diving deep into making it happen, even if your piggy bank is light.
So what's the magic trick here? How do you snag a rental property with $0 down?
Ken's main thesis is all about creative financing. He argues that using techniques like sub-2, where you take over the property's existing debt, and seller financing can help you get into the real estate game without needing a huge upfront investment. Voila!
Let's break down these key points. Starting with expired listings and foreclosures. What's the deal there?
Expired listings and foreclosures are gold mines. Ken points out that around 15,000 listings expire daily in the U.S. You can call those sellers directly and offer to take over their payments using the sub-2 strategy. It's like fishing in a barrel, if you will.
And for those unfamiliar with sub-2 and seller financing, what's the scoop?
Sub-2 is all about taking over existing debt payments without needing to qualify for a new loan. Just make the payments. Seller financing, on the other hand, means the seller acts like the bank. They finance the purchase, often because they own the property free and clear. It's like borrowing directly from a rich uncle, but without the awkward Thanksgiving dinners.
Nice. Any tools or websites to help set this all in motion?
For sure. Ken recommends websites like investorlift.com for pre-negotiated sub-2 and seller finance deals. Need something more outlandish like a ranch? Check out landwatch.com, where many listings already offer seller financing.
What about creative deal structures?
Ken mentions you can spice things up in endless ways, offering higher prices for flexible terms, covering agents' commissions, you name it. And for an exit strategy, consider the co-living model. Renting by the room ups your rental income significantly. Think of it as real estate crowd surfing.
So what does Ken predict for the market trends in this arena?
First, he anticipates more expired listings as high interest rates persist, offering more sub-2 opportunities. And he's betting on increasing demand for creative financing as traditional routes become pricier and more restrictive. Essentially, get ready for the creative financing fiesta.
Wrapping this all up, what's the final takeaway?
Ken drives home that anyone can get into real estate through creative financing techniques. Learn about sub-2 and seller financing, hunt deals online, and think outside the box. There's no one-size-fits-all, but there's definitely room for everyone at this dinner table.
Hello, everyone, and welcome back to another episode on the Real Estate Mindset channel. We've got a juicy topic today.
Absolutely. Today we're digging into a conversation about mortgage delinquency skyrockets, homeowners issue warning, featuring expert Melody Wright. Buckle up.
So what's the main gist of this video? Why is homeownership breaking America?
The core thesis is that owning a home, especially in the current climate, is causing significant regret and financial strain for many Americans. Melody highlights how rising mortgage delinquencies and societal pressures are pushing people into premature and often unwise home purchases.
Let's unpack that. What's driving this homeowner's remorse?
Many new homeowners are feeling trapped by unexpected costs and life changes. They're overwhelmed by financial responsibilities they didn't foresee, like rising property taxes and insurance premiums. It's like buying a ticket for a luxury cruise and finding out you've got to row the boat yourself.
Ouch! And I heard there's some eyebrow-raising data about mortgage delinquencies. What's the scoop there?
Indeed. Melody points out that there's been a staggering increase in mortgage delinquencies, which signals serious financial trouble for many homeowners. She notes that data from institutions like Black Knight is severely underreporting the real situation, capturing only about 1/3 of true delinquency cases.
So, bad data strikes again. What are the consequences of this misinformation?
Well, it creates a doom loop where flawed data misleads professionals and consumers alike. This leads to poor financial advice and more bad decisions. It's like getting a weather report that says sunny right before a monsoon hits.
Rough. And it sounds like unexpected life events are pouring salt into the wound?
Absolutely. Medical emergencies, sudden property damage, and personal relationship changes can all lead to massive financial strain. Many homeowners are finding themselves financially underprepared and emotionally exhausted.
Got it. Seems like societal pressures are also pushing people into this bind?
Spot on. Melody discusses how societal expectations make people rush into buying homes to feel accomplished or successful, often ignoring the real risks and costs. It's like buying a sports car because all your friends have one, then realizing you can't afford the gas.
Time to peek into the crystal ball. What does Melody predict for the future?
She anticipates that without a considerable change in societal attitudes and better data accuracy, the trend of financial strain and regret among homeowners will continue. However, she also hopes that growing awareness might make future buyers more cautious and prepared.
To wrap it all up, what should everyone take away from this?
Melody emphasizes the need for more awareness and preparation. She calls for buyers and financial professionals to critically assess data and not be swayed by societal pressures or misleading information. It's all about making informed, realistic decisions to avoid financial pitfalls.
Welcome to the Jason Walter channel on YouTube. Today we're diving into the latest housing market updates that reveal some surprising trends. Jason Walter himself is here to tell us why the housing market looks like it's hit a wall.
That's right. Jason's video uncovers key metrics showing that despite lower mortgage rates, the market isn't looking too hot. Let's break it down.
So, what's the crux of Jason's latest update? What's causing the housing market heartburn?
The gist is that even though mortgage rates have dropped, we're seeing a significant drop in pending home sales and a record high in price reductions. The market is facing a serious affordability issue.
Got it. Let's dive into those key points. What's the situation with pending home sales and price drops?
Pending home sales have taken a nosedive, the biggest dip in 8 months. Plus, the share of price reductions is at an all-time high, which is unusual for mid-July, since these reductions typically peak in the winter.
Interesting. How's housing inventory looking?
Inventory is close to a 4-year high, which is a relief for buyers. But it's been a mixed bag lately with a slip in the top 2 weeks.
Lower mortgage rates should be good news, right?
Yes, rates are now around 6.8%, down from 7.5% in April. This has given buyers an additional $25,000 in purchasing power. However, home prices are still hovering near record highs.
That's a tough balance. What about housing affordability?
Despite the lower rates, affordability remains a major issue. A typical homebuyer's monthly payment is still quite high, with home prices close to all-time records.
What are the folks at Redfin saying?
Redfin's Homebuyer Demand Index and Google searches for homes are down, signaling that buyers might be holding off, waiting for better deals on prices and rates.
Given all these factors, what's Jason's outlook for the market in the near term?
He expects home prices to level off rather than plummet unless we see a major increase in inventory or significant job losses.
And what about those tantalizingly low interest rates?
They're good, but not a silver bullet. While lower rates help, they may not offset the high home prices adequately.
So what's the final word?
Jason advises staying vigilant. Despite lower mortgage rates, the market grapples with affordability challenges and high home prices. Keeping an eye on inventory and buyer trends will be crucial in the coming months.
Hey folks, welcome back to BiggerPockets. Today's episode is a roller coaster of real estate talk. From potential Airbnb bans to sinking cities, we've got a lot to cover. Joining us are the insightful Henry Washington, James Dannard, and Kathy Fecky. Let's dig in.
Absolutely. We're breaking down head-scratchers like the impact of private equity in commercial real estate and what happens when cities literally start sinking. Ready? Let's jump in.
So, what's the main takeaway from today's panel discussion? What headlines are our experts decoding?
We're dissecting how private equity firms are swooping in on distressed commercial properties, the future of Airbnb amid increasing bans, the financial impact on homebuyers post-NAR settlement, and the curious case of American cities that are literally sinking.
Let's dive right into private equity in commercial real estate. What's the scoop here?
The scoop is there's almost $1 trillion of commercial real estate debt maturing this year. Private equity firms are stepping in, looking to snap up these distressed properties to stabilize the market before foreclosures occur.
Private equity to the rescue. Now, how about those Airbnb bans? Could we see short-term rentals vanish in big cities?
Well, Barcelona has announced a future ban, hoping to address housing shortages. But other cities like LA are taking a more measured approach, allowing short-term rentals with certain restrictions. It's a balancing act between tourists and long-term residents.
Got it. Switching gears, let's talk about the NAR settlement. How might that affect homebuyers?
The big fear is extra thousands of dollars in costs for buyers who might have to pay agent commissions out of pocket. But the experts think this may not happen. Negotiation will be key, and buyers might find creative ways to include those costs in the purchase price.
Great news for buyers. Finally, tell us about the sinking cities. Should we be worried?
Cities like New York and Miami are sinking due to natural and man-made causes, raising homeownership costs by up to 8%. This is adding pressure on insurance and local taxes. Research your area well and make sure properties are in safer zones.
Time for some predictions. What's in store for commercial real estate?
Expect private equity to stabilize the market by acquiring distressed properties before forced foreclosures pick up steam. It's a save-the-day scenario.
Exciting. How about Airbnb regulations?
We might see a more regulated short-term rental market rather than a complete ban. Cities will find a middle ground to balance interests.
Now, homebuyers post-NR settlement.
Don't panic. Buyers probably won't fork out large sums directly to agents. Expect creative negotiations and a potential slight bump in costs.
Phew, and those sinking cities?
Environmental challenges will push up local taxes. Ensure you know the municipal risks and prepare for higher insurance costs.
Wrapping it all up, any final thoughts?
Stay informed and be adaptable. Whether it's regulatory changes, market shifts, or environmental risks, smart investors should always be one step ahead. Ready for the challenges, folks?
Welcome to Real Estate Mindset on YouTube. Hold on to your hats because today's video is absolutely bonkers. Eric Nelson dives into Zillow's latest data showing a massive surge in home inventory and price cuts across the housing market.
Eric's deep dive pulls no punches. It's all about how the market's not as resilient as those rosy headlines suggest. Get ready for some eye-opening stats.
So what's the main takeaway from Eric's latest video? What's the big revelation here?
The core thesis is that the housing market is far less resilient than headlines might suggest. Zillow's data shows skyrocketing inventory and increasing price cuts, pointing toward a market correction due to unaffordability.
All right, let's break down those key points. First up, what's happening with housing inventory?
Zillow's data indicates a dramatic 23% year-over-year increase in housing inventory as of June 2024. While inventory is still 33% below pre-pandemic levels, this small deficit is the best since fall 2020.
And what about those price cuts? What's the scoop there?
Nearly 24.5% of listings received a price cut in June 2024, the highest for this time of year since 2018. Clearly, sellers are getting anxious.
Next up, let's talk affordability. What's the picture there?
Despite easing mortgage rates, home ownership costs are rising faster than wages. The typical American household needs $127,000 or 35% down to afford a home. Yikes!
What comparisons are being made between different data sources?
Yeah, good catch. Zillow and Redfin have conflicting data on days on market. Zillow says 15 days, Redfin says 32. It's like they're not even talking about the same planet.
So, predictions time. What's in store for the market according to Eric?
Eric predicts an ongoing market correction. The surge in inventory and rampant price cuts suggest that the market is correcting and will continue to do so as long as homes remain unaffordable.
And as we wrap it up, what are the major takeaways?
Eric emphasizes strategic caution. He suggests that patience and preparation will yield better deals. The key advice? Carefully analyze local and market-specific data before making any buying decisions.
Hey everyone, welcome back. Today we're unpacking some big updates about the California housing market. Jason Walter has just dropped a detailed report, and trust us, you don't want to miss it.
Absolutely. There's good news if you're a house hunter, but also some bad news if you like bargains. Jason's latest video breaks it all down, from rising prices to the latest inventory numbers.
So what's the main scoop from Jason's update? What's the state of the California housing market?
Jason covers the yin and yang of the market. More homes for sale, but prices that are flirting with all-time highs. It's a mixed situation influenced heavily by high mortgage rates and changing inventory levels.
All right, let's dig into the key points. Start us off with housing inventory.
Sure thing. The big positive is a 36% increase in houses for sale compared to last June. More homes on the market should give buyers more options. However, even with this boost, the overall inventory is still quite low.
And what about home prices? Are we hitting new records?
Pretty much. The median price is over $900,000, which is one of the highest ever. This is despite mortgage rates being around 7%, which historically would put the brakes on such high prices.
Ouch, sounds pricey. How are sales looking in this environment?
Sales are tough. They're down 2.7% from last June and close to matching the low levels seen in 2022. High-value homes are still selling, but affordable homes, not so much. We're talking a 26% drop in sales for homes priced between $300,000 to $400,000.
Yikes. Talk about a tough market for first-time buyers. Any other market dynamics we should know about?
Yes, the high interest rates and the increased inventory are slowing down price growth. Also, luxury homes are doing better, but that pace is slowing too. It's a complicated picture, but definitely trending toward balance in certain segments.
So what's next? Jason must have some predictions.
Indeed. With pending home sales down 2.5%, we can expect the current trend of low closed sales to stick around for a while. As for market competitiveness, it might drop, but not by much, from its current high compared to pre-pandemic levels.
Let's wrap it up. What's the big takeaway from all this?
The bottom line is, while there are more homes for sale, prices remain high, and the market is still fiercely competitive. Sellers have the upper hand for now, but future inventory increases could help level the playing field.
Welcome to BiggerPockets on YouTube. Today's topic: buying rental properties in 2024, and our special guide is Dave Meyer.
Dave is breaking down the process into 3 game-changing steps: finding leads, evaluating deals, and making offers. If you're dreaming of financial freedom, this is your roadmap.
So what's the main takeaway from Dave Meyer's presentation? What's the secret sauce?
Dave's core message is simple. By mastering 3 repeatable steps, finding leads, evaluating deals, and making offers, you can demystify real estate investing and genuinely take control of your financial future.
Let's dive into the first step: finding deals. How does Dave suggest we start?
Dave stresses the importance of generating leads. He mentions 3 main strategies: direct mail, setting up a website, or driving for dollars, all aimed at scoring those elusive off-market properties.
But he seems pretty keen on one method in particular, right?
Absolutely. Dave swears by working with an investor-friendly agent. It's like having a shortcut through the maze. They help sift through MLS listings and often have access to off-market gems.
All right, moving on to evaluating deals. What's the lowdown there?
Dave outlines a 5-step process: property info, purchase details, loans, rental income, and expenses. He demoed the BiggerPockets rental property calculator, showing just how straightforward it can be to assess a property's potential in minutes.
And for those new to the game, any tips?
Dive into tools like the BiggerPockets rent estimator. It'll give you confidence in your rental income assumptions. Plus, engage with a property manager or another investor. Real estate is a team sport.
Finally, let's talk about making offers. How do we seal the deal?
Dave's got 7 golden rules for you. Be the first or last to offer. Keep your contract clean. Offer the seller their price but on your terms. And remember, negotiation is a partnership, not a duel.
So it's all about strategy and flexibility.
Exactly. Tailor your offer to what the seller needs. And if your offer doesn't stick, reassess and reoffer. Persistence can pay off big time.
What's in the crystal ball for those who master these steps?
Financial freedom is the name of the game. By consistently finding, evaluating, and offering on quality deals, you'll build a solid portfolio and wealth over time. One rental property at a time.
So what's the big takeaway here?
Stay consistent, use the right tools, and partner with experienced mentors. Dave highlights how BiggerPockets Pro wraps these elements into one powerful package to help you on your journey.
Nick Gurley discusses Texas and Florida's struggling housing markets due to surging inventories. He predicts continued price drops.
Ken McElroy introduces creative financing strategies for buying properties. He's optimistic about these methods opening doors for many.
Melody Wright highlights rising mortgage delinquencies and regrets among homeowners. She warns about misleading data from major institutions.
Eric Nelson compares Zillow and Redfin's housing market data, indicating a significant correction ahead. Zillow reports soaring inventory and widespread price cuts.
All our experts agree that housing affordability remains challenging, though opinions vary on the extent of the market corrections.
Stay tuned to Financial Insights in Minutes for more in-depth analyses and diverse perspectives on these pressing issues. Till next time.
Thanks for watching Financial Insights in Minutes for July 20th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.